The investor who won big once and spent a lifetime chasing it. Introduction. In financial markets, a single extraordinary win can reshape an investor's psychology forever. A stock that multiplies. A crypto asset that explodes. An options trade that delivers life-changing returns. For some, that moment becomes a reference point and a trap. One big win can create an endless search for the next one. This research explores the behavioral biases, neurological mechanisms, and long-term consequences of investors who experience a major early success and then spend years trying to replicate it. 1. The psychology of the first big win. 1.1 Dopamine imprinting. Large financial gains activate powerful reward responses in the brain. The emotional intensity of sudden wealth imprints deeply. The investor does not just remember the money. They remember the feeling. That emotional memory becomes a benchmark for future satisfaction. Ordinary returns begin to feel insignificant. 1.2 Anchoring bias. Behavioral research by Daniel Kahneman shows that people anchor to salient numbers and experiences. If someone turned $10,000 into $200,000 once, future gains of 8 to 10% annually feel trivial, even if mathematically superior over time. The anchor distorts expectations. 2. From investing to gambling. 2.1 Overconfidence effect. After a major win, investors often attribute success to skill rather than luck. This phenomenon has been widely observed in speculative bubbles, including the dot-com bubble. Early winners believed they had unique insight. Many increased risk exposure just before collapse. 2.2 Variable reward reinforcement. The dynamic resembles casino psychology. Large, unpredictable reward. Long quiet periods. Intensified search behavior. This is the same reinforcement structure used in slot machines. The investor begins chasing intensity rather than probability. 3. The structural shift in behavior. After a large win, many investors increase position sizes, seek high-volatility assets, abandon diversification, reject steady compounding, dismiss boring strategies. Steady 7 to 10% annual growth no longer satisfies them. They are not investing for wealth. They are investing for repetition of a peak emotional experience. 4. Market cycles and the illusion of repeatability. Major bull runs, like the rise of Tesla Incorporated or early investment in Bitcoin, create stories of sudden transformation. But these events are rare and often tied to unique macro conditions, liquidity expansions, technological paradigm shifts. The probability of repeatedly catching exponential moves is extremely low. Yet the memory of having done it once distorts perceived odds. 5. The emotional consequences. 5.1 Chronic dissatisfaction. Moderate gains feel like failure. 5.2 Escalating risk. To recreate the emotional high, the investor increases exposure. 5.3 Capital erosion. Chasing rare outcomes often results in large drawdowns, portfolio volatility, long recovery periods. Ironically, the first big win may become the beginning of long-term underperformance. 6. The mathematics of compounding versus chasing. Consider 110x return followed by poor decisions versus 20 years of 10% compounding. The second path often produces greater wealth with far less stress, but it lacks drama. Markets reward discipline. Memory rewards intensity. 7. Breaking the cycle. To escape the chasing the first win trap, separate luck from skill. Redefine success as sustainable growth. Accept that extraordinary gains are rare events. Create rules-based allocation systems. Focus on process, not emotional peaks. The goal shifts from "How do I do that again?" to "How do I build something durable?" Conclusion. A single large win can be a gift or a curse. If it creates confidence grounded in discipline, it becomes foundation. If it creates addiction to intensity, it becomes a lifelong chase. In investing, the most dangerous return is the one that changes your expectations forever. True mastery is not repeating a miracle. It is building a system that works, even when miracles do not appear.